Good evening, everyone. Time for this week's silver update. This is the 8-hour chart of gold provided by netdania.com. You can click on the link below. And we had a very significant rally today. The explanation given, of course, was the horrific jobs number that came out around 60-something thousand with an expected 150,000. So really bad number, and of course they've been cooking the numbers up until now, so we know that things are starting to turn down for the economy. Now, I'm going to end up spending most of the night on the charts because this is such a key change here, but the traditional or the common understanding explanation for this type of maneuver in the metals, as you know, the move in the stock market was down over 200 points for the Dow, and we'll show that when we do an overlay of those charts. But the traditional explanation for that is that we're more likely to see quantitative easing, and with such a bad number, and therefore the gold price rallied. Now, I don't really necessarily buy into that for a couple of reasons. We'll explore that a little bit later, but the first reason being that if we look over at the percentage moves, you can see in gold we had a 4% move, 4+% move, $62.67 in one day. Silver was up about 77 cents. That's a 2.8% move. So we had a much larger move in gold than we had in silver. You would expect that if we were looking at inflation, that you'd see a commensurate, especially with silver being so oversold, you'd expect there to be a commensurate higher move in silver, especially because of it being sold off due to a deflation scare. You would expect that if this was an expectation of further QE, that you would see silver keep up. So that story there seems to indicate to me that this may be more of a default or deflation hedge buying coming into the metals as opposed to an inflation bet. The other thing that gives me pause on that, of course, is that the stock market went down 200 plus points. If people were convinced that a QE3 is in the cards, why would the stock sell off so hard? So I'm not yet convinced that that is the reason or the explanation for it. It may actually be that the cartel has just kind of ceded the issue and is backing off. So we'll see if there's follow through on this. Now, the technical picture is very striking here. You can see the most recent trend line that we have. I've drawn it from the 1790 top that was made in early this year, and it comes down. You can see it was clearly penetrated to the upside by just today's rally. There was also a smaller trend line that we'll draw here that was building, but you can see that was just crushed. So we went through that one. We went through the next one, and we're approaching this one here. This one I've drawn here, it cuts out this section as an outlier, and the reason why I did it is because we get 1, 2, almost 3, 4, 5 or so touch points here, and so that's the next line, and we very well could get through that. Now, if we draw the final line with matching this high point here, then we get all the way up to about 1725 in gold, so it would take a significant move to get through that. But if you look at today's move, just a series of daily moves could take you through those prices without much difficulty. Gold tends to move very rapidly when it does start moving. So let's clear off the indicators now and go ahead and do an overlay with the stock market so I can show you what I'm talking about. The move in opposite directions could not be more striking. And you can see it with, we'll move back one so we're tighter to the 4-hour, and you can see the absolute drastic difference here. If you look, well, maybe it'll be better in the 2-hour. Well, we can come back if it's not. So you can see here in the 2-hour a very tight correlation, not super tight, but pretty tight correlation here between these two prices. And yet, when we, let's get rid of the line here, and yet when we get this news today, you can see we get the big drop here in the stocks, and we get this huge rally in gold. So they're moving in absolutely opposite directions in very dramatic fashion, and that is portending what I was hinting at yesterday, that we should see a disconnect due to safe haven buying and just a flight to safety. Now, traditionally, and we're going to talk about this a little bit when we look at the bonds, the traditional flight to safety is to treasuries or dollars, and it really should be, if we're talking about a serious safety crisis, not maybe a liquidity crisis, but a solvency crisis or a default crisis, really we all know that the flight to safety should be to silver and gold. So today perhaps was the beginning of that sort of trend. Now the silver was not quite as strong percentage-wise as I pointed out, but when we look at the move here and put in the trend lines, of course, the long-term formation here in silver, let's do the 8-hour instead. You can see the long-term formation here in silver is just this phenomenal chart. And if we draw, we also take that outlier out there because it gives us so many touch points. You can see if we draw it right about here, we get 1, 2, 3, 4, 5, close to 6 touch points by going excluding that line. So that's going to be one we're looking for. Now the short term is kind of hit and miss, so we don't have as definitive of a move here in silver. But if you remember, I said a couple episodes ago that we were tightening up into a pennant formation. I didn't know whether we were going to go up or down out of it, but that I did expect it to be quite a move, and that's what we got today, at least in gold, and we may get follow through and get quite a move in silver. So the other chart I wanted to look at is the oil chart, and we did get kind of a bottoming formation on oil, but you can see we've moved such a dramatic amount. Now again, with the QE expectation, one would expect that if the move in gold were based upon a QE expectation, we would see more of a rise in oil than we saw here. So that's another indication to me that it's not QE expectation that caused gold to rise, but it is default risk, flight to safety. Now the euro chart, we did get a rally in the euro, and that may just be knock-on weakness of the dollar, knock-on effect, and maybe this trend will turn around. But now we're starting to weigh the relative bad situations, comparing how bad it is in the United States to how bad it is in Europe. And so these are the ugly stepsisters here. No one really wants to get stuck with either one. And the last chart is the US dollar Japanese yen. The yen is strengthening now against the dollar. If you remember, I pointed out in the past we've had major intervention. We had major Fukushima intervention, and we've recently had major intervention again. Of course, as I've pointed out many times, Jimmy Rogers says, if you want to fade the central banks, then the key to that trade is to wait for the rally and go the other way. You can see that these were easy money trades Once you waited for the central bank intervention rally to peter out, then you just piled on the other direction. You got yourself a nice good trend. We've got another nice good trend going the opposite direction again. So I expect we will probably make new lows in the dollar against the Japanese yen, and that probably will be an occasion for more intervention. So let's go over to the question of the night, and that is from SRJ19. And they ask, what implausible scenario brings the rise in interest rates thought to be unthinkable? I keep hearing almost universally how it's guaranteed that we'll see low rates from here on out, which is good for metals, good for the markets, bad for savers and those who buy treasuries. Hasn't the Fed and the government shown, though, that they'll make pretty bad choices in the short term in order to extend things? Do you think that it would go that route just temporarily, of course, in order to preserve reserve status? Lindsay Williams asserts rising rates are coming and soon. I was just wondering how such an event would play out. Of course, if his larger assertion is on target, the intent would not be to extend the system, but instead to weaken it further. A rise in rates would be in line with his scenario of a dead dollar by year's end. It could be the choice they make when they have no choices left, Scott. So, very interesting question. Now, just to jump ahead here, that a rise in rates could be in line with the scenario of a dead dollar. Actually, a very substantial rise in rates would be in line with a saved dollar, which is what we had in the early 1980s with Paul Volcker ratcheting interest rates all the way up to 20%, which strengthened the U.S. economy, choked off inflation, and saved the dollar. So that's not likely to happen this time around, as many have pointed out, that an interest rates that high would bankrupt us because of the national debt. So that's not likely to happen. But back to the main question, which is, do they control the interest rates, and will they rise? So I wanted to take kind of a different tack in answering that question. I pull up a chart from, this is from more research, the free charts. I'll link this below. And this is a chart of the long-term 30-year T-bond, and you can see it goes back to 78, 79. That period I was talking about when the interest rates were ratcheted up by the Federal Reserve under Volcker. You can see here we actually touched about 46 or 47 on the long bond in price. And then we've subsequently rallied all the way up to where we are now, which is above 150. So an unbelievable rise, one of the largest bull markets in the history of the world. And the reason why I brought this chart up is to show you that this is just simply rising prices. Now, if you can imagine, someone would say, well, and they talked about the bond vigilantes, and the bond, they're going to sell off the bonds and they're going to lose control, and they can't control long-term interest rates. I think that's pretty much been proven to be false. So if you just think about it in other terms here, as this is just a market and the government is buying things in the market, you can see how it wouldn't be at all difficult to control the price. Now, this is inversely related to interest rates. So the higher this price, the lower the rate. Now, if you imagine if it were a car or a house, just imagine if the federal government, for example, for whatever reason, you can pick whatever you want. Let's just pick the Honda Civic. And let's say that the government, or the Honda, whatever you want to pick, a car. The government decides this car, we're going to peg this car at a certain price, and we're not going to let it fall below that price. So this car, even though it's not worth anywhere near that, we're going to peg this car at $50,000. We want that price to be that high. And anytime that car is selling below that price, we're simply going to buy it. And we'll buy it up until it is that price. Now, if you think about it in those terms, you can see that it's clear that the government clearly has the power to do that, because they have the power of the printing press, and they can just simply print up the money they need to buy whatever it is they want to buy, and keep the price up. The same thing is true for treasury bonds. If the government wants to buy treasury bonds with printed money, they can buy as many as they want or need to, and that's exactly what we see here. So I don't buy into the bond vigilante story. I don't buy into the panicked buyers exiting or China exiting or anything. It doesn't matter. If the Federal Reserve decides that they want to buy treasuries, they will print up as much money as they need to set the price as high as they want, and therefore set the interest rate as low as they want to set it at. And there's nothing to stop them from doing that, and I think that's what we've seen. So I do not expect interest rates to spike up until they decide they want them to, and I don't think this time they're going to decide the way they did with Volcker, because like I said before, they can't do it because they're just not in a position with the national debt the way it is to be able to pay the debt, the interest on the debt. So I don't think that's going to happen. Now, if you do print up money and then buy up a whole bunch of something, supply and demand, market forces tell you, let's say for example that it were the Honda Civic or another car, and it was pegged at $50,000, way above its true value. Well, you can imagine that whoever's producing it is going to produce a heck of a lot of them, considering it's that profitable, and you're going to end up with a tremendous glut. That's what you get when you artificially peg prices too high. You end up with a glut. And so what are we going to have a glut of? Well, obviously by pegging the price of these interest rate instruments too high, which means you peg the interest rate too low, it means you're going to get a glut of them. And that's exactly what we have. We have a glut of U.S. Treasury debt instruments. And that is going to have an impact at some point. But again, it's all in the hands of the Federal Reserve with how much money they want to print. Now, the last thing I want to look at, I did a little shopping around trying to find the best buy out there, because I think we stand a very good chance now. Let's come in closer here to the silver chart. We stand a very good chance now of having put in a pretty good bottom if this thing has legs. And so for those who are late to the party and want to jump in and think this is perhaps going to be that bottom, then now is probably a good time to buy, although I think with silver being so cheap that any time is a good time to buy. So I did a lot of shopping, and I came across one that I actually have never covered before because I never really liked it, and that's the 2012 1-ounce silver Britannia. Now this one to me is not like, actually I've got an even closer up picture here. This is a close-up of the Britannia 2012, and I must say I really like this coin. I can't say why I like this coin. I didn't like the other Britannias. If you get a chance, go back and look at the previous Britannias. Some of them, in my opinion, were just hideous. This coin, in my opinion, and this is just my artistic opinion, so for whatever that's worth, I think this coin is a winner. And now it is a little bit overpriced if you look at it. It's set to, let's see, it was it's $5 above spot, so you can get these for $33.97 if you buy 100 plus. I checked Atmex, I checked Provident, and checked Gainesville. Gainesville here has the lowest price just by a bit. They're about $34.05 at Atmex. So you get this coin a little bit $5 over spot. I've paid $5 over spot before. I think I did with the 2010 Tigers, but that's still a little steep when you consider that you can get your Eagles or your Maples or other things for $2 to $3 over spot. So you are paying a little $2 premium. I will call it a semi-numismatic play because it's just an extra $2 on it. So I really like this coin. I hope I get a chance to pick some of them up. For my sake, I hope that I'm wrong and silver turns around and crashes down to like $22 or something. I'd love to be able to pick up some of those coins for $27. So the big story of the day is gold and the reversal that we had in gold. This looks like something that may end up having legs. and if it does, we can make a run very quickly to the old highs. And of course, I think that silver will eventually come along for the ride and also then surpass the price move, hopefully testing those old highs in silver as well. And we'll talk to you next time.